Is the AI stock rally the greatest investment opportunity of our lifetime? Or are we watching a bubble inflate in real time that's going to devastate portfolios when it pops? This is the question Wall Street can't agree on right now. And the answer matters enormously for your money, because we've seen this movie before. In 1999, everyone said the internet was different. In 2007, everyone said housing only goes up. In 2021, everyone said cryptocurrency was the future. And every single time, the believers got rich for a while and then got crushed when reality hit. So today, I'm going to present both sides of the AI debate with data, not hype. We'll look at what the bubble believers are saying, what the AI bulls are arguing, and most importantly, I'll give you a practical framework to navigate this market, whether it's a bubble or not. Because here's the truth. You can make money in the bubble if you know what you're doing and you know when to get out. But you can also lose everything if you're the last one holding the bag. Let's dive right in. Let's start with the bearish case. Why are smart people warning this looks like a bubble? First, survey data is flashing warning signs. Bank of America latest global fund manager survey shows that AI stock bubble is now identified as the #1 tail risk by professional investors. These aren't random people on the internet. These are institutional fund managers controlling hundreds of billions of dollars. Second, valuation metrics have reached extreme levels. Nvidia stock, which has been the poster child of the AI boom, is up approximately 1,400% from its 2022 lows. The S&P 500 over the same period is up 81%. That's a 17-to-1 outperformance ratio. Historically, when a single sector or theme outperforms the broader market by that magnitude, it rarely ends well. Third, we're seeing pricing to perfection across the entire AI supply chain. And there's Liz Ann Saunders, the chief investment strategist at Charles Schwab, noted that current valuations in AI stock assume flawless execution, perpetual growth, and zero competition for years to come. There's literally no room for mistakes. One earnings miss, one guidance cut, one slowdown in spending could trigger a violent re-rating. Fourth, JP Morgan CEO Jamie Dimon, who has lived through multiple bubbles and bust cycles, recently stated he believes many assets are entering bubble territory. When the CEO of America's largest bank says that, you need to pay attention. Fifth, we're starting to see speculative excess in smaller AI names. Companies with no revenues, no profits, just AI in their business description have seen their stock triple or quadruple in months. That's classic late-stage bubble behavior. It happened when the dot-com stocks in 2000 with the SPACs in 2021, and it's happening again now with AI. And finally, there's what I call the cocktail party indicator. When your uncle, who knows nothing about technology, starts giving you AI stock tips, when every financial influence is pumping AI plays, when CNBC runs daily segments on the AI revolution, that's often a contrary indicator. Maximum bullishness often coincides with maximum risk. Now, let's hear the other side, because to be fair, there's a genuinely compelling bull case for AI stocks. First, the revenue is real and it's accelerating. TSMC, Taiwan Semiconductor Manufacturing Company, which makes the chips that power AI, just reported third quarter results on October 16th, and the revenue surged 40.8% year over year to around $33 billion. Profits jumped 39%, and that's not speculation. That's hard earnings growth. Now, we all know about the circulation of finance between OpenAI and multiple other companies, and we're not ignoring that. And that is, in my opinion, financial engineering. But let me continue. TSMC raised its full year 2025 revenue guidance to mid-30% growth, and their CEO said that the explosive growth in token volume indicated rising consumer adoption. So translation is every time you use ChatGPT or any other AI tool, you're generating demand for these chips. Second, there is massive infrastructure spending, and it's locked in for years. OpenAI announced a landmark deal with NVIDIA for 10 gigawatts. They also invested $100 billion as each gigawatt is built. OpenAI struck a multi-year deal with AMD. CoreWeave is connected with them. CoreWeave is connected here. We have Anthropic's connected there. Everybody's entangled into this web of financial engineering. But the money they're spending is real. Meta and all those large companies, if they don't spend, the risk to their business is higher than spending and failing. And you can watch an interview with Mark Zuckerberg talking about that exact same thing. He said that if we don't spend, then we risk much more by falling further behind these other giants. But they can spend $200 billion and fail and still be okay. Think about what that means. These aren't quarterly contracts. These are multi-year, multi-billion-dollar commitments that creates years of revenue visibility. The problem with this infrastructure, it ages out pretty fast. 3 to 5 years, and now you got to build more data center. Now, third thing, we just saw a major signal this week. And we know that smart money is doubling down. BlackRock, the world's largest asset manager, and NVIDIA, and Microsoft, and MGX formed a consortium to acquire Align data centers for $40 billion. The consortium, called the Artificial Intelligence Infrastructure Partnership, is initially deploying $30 billion in equity with the potential to expand to $100 billion, including debt. Larry Fink, the BlackRock CEO, said that the goal is to build the infrastructure to power the future of AI. Now, when BlackRock writes a $40 billion check, they're not chasing a bubble. They're positioning for a decade-long trend. Fourth, unlike past bubbles, the current AI boom is what Liz Ann, the CEO of TSMC, calls an equity finance boom rather than a debt finance boom. Because in 2008, real estate was bought with crazy leverage. In 2000, dot-com companies burned through cash and went bankrupt. But today, AI leaders, Microsoft, Google, NVIDIA, and Meta, are generating massive free cash flow and funding their growth from operations. That's fundamentally more sustainable. Still risky, but sustainable. And the big risk here is that a lot of these companies are providing AI for free. So they want to get you hooked on AI so that you can't go a day without it. And once that happens, then they'll start charging you. Fifth, enterprise adoption is still in the early innings. Okay? And this means that according to analyst Ben from the Milius Research, AI infrastructure spending could create a total addressable market of over $2 trillion by 2030. He believes that NVIDIA alone could capture 40% of that market. That's $800 billion. And it could deliver over $400 billion in data center revenue in 2028. His price target on NVIDIA is $275, implying 47% upside from the current levels of around $188. And finally, we're seeing real-world AI applications translate to business value. It's not just hype anymore. Companies are using AI for customer service, code generation, content creation, drug discovery, autonomous vehicles. When the use cases are real and measurable, ROI exists, but it's still very, very small. Then this supports continued investments. OpenAI spends $100 billion a year, and they only make 6. Long term, that is unsustainable. So, what do you do with all this information? Here's the practical framework for navigating AI stocks, regardless of whether it's a bubble or not. Rule number 1, never let a single theme dominate your portfolio. Because I don't care how bullish you are on AI, it should not be more than 20 to 25% of your investment assets. Because if you're wrong, or even if you're right, but the timing is off, you need to survive to fight another day. Diversification isn't about maximizing gains. It's about ensuring you're still in the game when opportunities arise. Rule number 2, distinguish between picks and shovels. In the 1849 gold rush, most miners went broke. But you know who got rich? The people selling picks and shovels. In the AI, the miners are the companies trying to build AI applications. They're high risk. The picks and shovels are companies like TSMC, NVIDIA, and data center operators who get paid regardless of which AI app succeeds. If you're going to overweigh anything, overweigh the infrastructure layer. Rule number 3, demand cash flow, not promises. Any AI company you invest in should be either already profitable or have a clear path to profitability with existing revenue. I don't care about their vision. I don't care about their TAM, total addressable market. If they're burning cash and they're saying we'll be profitable at scale, that's red flag. Focus on companies like Microsoft, which generate $83 billion operating cash flow last year while building AI. That's how you play growth without speculation. I hate these quantum plays with these companies valuated at $15 billion and they have zero revenue. It doesn't make any sense. Rule number 4, use position sizing and stop losses. Rule number 5, stage your entries. Rule number 6, watch the 5 bubble indicators. Valuation, if PA ratios expand as growth decelerates, that's a warning sign. Insider selling, if executives and early investors are dumping stocks, pay attention. Secondary offerings, if companies are rushing to sell new shares into the market, they think their stock is overvalued. Sentiment surveys, when bullishness reach 80 to 90%, that's often a local top. Volatility, if a stock is swinging 10% in a day with no news, that's speculation, not investment. Rule number 7, have an exit plan before you enter. You should decide in advance at what price will I take profits, at what valuation will I trim, at what point will I sell completely. Write it down, because in the moment when your AI stock has doubled, emotions take over and you convince yourself it's going to triple. Having a preset plan removes emotion from the equation. What's next? We're heading into a critical period. Tech earnings season is in full swing, and the next 4 weeks will tell us a lot about whether AI spending is accelerating, stable, or starting to slow down. Here's what you need to watch out for. First, listen carefully to guidance from hyperscalers, Amazon, Microsoft, Google. They're spending tens of billions on AI infrastructure. If any of them suggest they're moderating that spend, AI stock will react violently. Second, watch NVIDIA's next earnings report in November. They'll report fiscal Q3 results, and guidance for Q4 will be critical. The market is pricing these companies for perfection. There can be no mistakes. NVIDIA is the bellwether. If they beat and raise, the whole sector will rally. If they meet expectations but don't raise, the sector could sell off because expectations are so high. Third, pay attention to utilization rates. It's not enough for companies to buy chips. Those chips need to be running at high utilizations to justify the next wave of investments. If we start hearing the utilization is dropping or the company's overbought capacity, that's a major red flag. Fourth, watch for signs of competition. AMD is making inroads with their MI300 and upcoming MI450 GPUs. If NVIDIA starts to lose market share faster than expected, that could compress their margins and growth. And finally, monitor the broader economy, because here's the thing. Even if AI is a genuine secular trend, it does not exist in a vacuum. If we hit a recession and corporate IT budget gets slashed, AI spending can still slow down. The fundamentals might be real, but cyclical forces can override fundamentals in the short to medium term. My expectation is that we'll see continued growth in AI infrastructure spending throughout at least mid-2026. But we'll also see increased volatility, multiple compressions, and a widening gap between winners and losers. The days of buy anything with AI in the name and watch it go up are probably over. From here, it's going to require actual stock picking and risk management, and we got to stop just zombieing into the S&P 500 and putting our money without thinking. So here's my bottom line on the AI bubble debate. I think the technology is real, the use cases are real, the revenue opportunity is real. But I also think expectations have gotten way ahead of reality in many corners of the market. The valuations are super rich, and the corrections are guaranteed to come at any point. Now, this doesn't mean you should avoid AI stocks entirely. It means you need to be selective, be disciplined, and be prepared for volatility. Own the highest quality names, limit your position sizes, and make sure you stop your losses where they need to be. And have an exit plan. And if you don't know what you're doing, please consult a professional. If you found this analysis valuable, this channel is still very new, please smash the like button and subscribe and hit the notification bell. And share this with people who are on the verge or on the edge and they're not sure which way to go. I'm putting out daily videos and warning you about market trends. I can't continue to recommend stocks to buy unless I'm absolutely sure, because I'm also on the verge of pulling out. The warning signs are plenty, and there's a lot of things in the right place for a market correction. I'm playing it safe with the same tactics I'm recommending. I'm being selective, I'm being disciplined, and I know there will be volatility. I have my stop losses in place, and I'm only selecting quality names. This is going to be a wild ride. But if you stay disciplined, manage risk, and focus on quality, there's a lot of money to be made. Until next time, stay diversified, stay safe. I'll catch you in the next video.